I want to walk you through what the 2026 budget actually means for those of you considering buying a property. There are four main kinds of buyers in Australia right now. You've got young investors, established investors, first home buyers or upgraders, and older homeowners. Last week's budget hits each one of you very differently. And if you're one of them, the next 5 minutes are for you. Let me go through what's changed on budget night. If you buy an established investment property now, you can't negatively gear the losses against your wage. They're quarantined to property income only, but they do allow you to carry those losses forward. New builds keep full negative gearing, and they've left that intact on purpose, and I'll get to that. Also, from the 1st of July 2027, the 50% CGT discount is replaced. Cost-based indexation plus a 30% minimum tax on real gains. Family home stays CGT free. Anything you owned before budget night is broadly grandfathered in. Reading this budget through the tax lens only gets you halfway there. The bigger move is in the property itself. So let's take each group in turn. Young investors first. This budget was meant to help you, but you're the most exposed. The old playbook, borrow heavily, buy an established place, negatively gear the losses against your wage, hold for capital growth. That formula doesn't work for anything established you buy from here onwards. The cash subsidy from your tax return is gone. You hold the property in full every year, no help from the ATO. So what does this mean for the asset? It has to hold up on its own. Quality, land content, real scarcity. Which brings me to off the plan. Here I'm going to be blunt. Off the plan is what developers will push hardest in this new world. The negative gearing carrot still works on a new build. The cash flows on paper look super attractive. Please don't fall for it. Off the plan is some of the worst performing stock I've watched Australians buy. You're paying developer margin baked into the price. You're buying a building, not land. Buildings depreciate. You're competing against 100 near identical units when you go to sell, and you wear settlement risk if the bank revalues lower. A 6% yield with full negative gearing on a property that goes nowhere over 10 years is still not a good investment. It's a tax efficient way to lose money. A piece of land in a tightly held suburb beats it every time, even now, even without the same tax breaks. So let's talk about an established investor. You're the most protected group in the whole package. Anything you already own keeps the full negative gearing, all the way through to sale. On capital gains, the 50% discount still applies to the growth that accrued before the 1st of July 2027. The new system only kicks in on the gain after that date. So the question isn't, should I panic and sell? It's, should I sell at all? In my experience, most won't. Holding periods will extend. Supply of quality established stock tightens. First home buyers or young upgraders. You're who the budget is for, at least on paper. A small softening in prices, modestly less investor pressure in some segments, marginally more owner-occupier ownership over time. Useful, but not transformational. And here's the bit to watch. Investors don't disappear, they shift. They go where the yields are. Outer suburbs, regional markets, affordable apartments, which is exactly where a lot of first home buyers compete. So in your segment, the competition might actually firm up, not soften. The buyers who win this next decade aren't the ones rushing in, they're the ones buying scarce, well-located stock with patience, just like the old days. Older homeowners, you guys came out on top, whether by design or by accident. The family home stays CGT free, decades of grandfathered growth untouched. As tax efficiency on every other asset class tightens, the family home becomes the most concessionally treated thing in your portfolio. Expect more Australian wealth to flow into upgrading the home, not building investment portfolios. Premium owner-occupier suburbs, already tightly held, get tighter. If you remember one thing from this, remember this. The tax rules have changed, but the bigger change is which properties are worth owning over the next 10 years. The tax tailwind is gone for new money. The only lever left is the asset itself. Quality, land, location, scarcity. The stuff that actually matters more today. Wherever you sit in these four groups, that's the shift. If you want to talk through what this means for your situation, the link below books a free call No pressure, no pitch, just get an idea of what you might do next.